Hey everybody, it's Larry Berman here. A little bit later on Friday afternoon than I'm used to. I'm actually out in Quebec City today at the Conservative Conference for the Conservative Party of Canada Policy Conference. We're going to hear Pierre Poilievre speak in a few minutes here. Many people know that I'm interested in perhaps a post-retirement career in politics. And while I'm still debating that, I think the idea of being finance minister in Canada is still very appealing. Um, I'm extremely frustrated at the quality of leadership that, Canada has, U.S. has, political leaders in general. And, I'm here to learn a little bit. I'm here to share some ideas. I'm here to move some ideas forward. And the important thing for me here is not being partisan, but policy. And so I do like to participate in these policy conferences and events and see if we can ultimately make a difference. Let's get into the chart room and see what markets taught us this week, because as a student of the market, as someone who loves to learn and loves to educate and teach, the messages to me are still very, very clear. But like in politics, what we see on the surface isn't always what is happening under the hood. We've talked about the massive amount of new bond supply that's going to be needed to fund deficits, going forward. One of the things that we did today in plenary session was to discuss economic policies and balanced budgets and, how do we reach our climate goal achievements, and do it in an efficient way from a budgetary perspective. So a lot of those things are very, very interesting to me. But, the bottom line is, in the US, and of course the US drives the world, they're going to run budget deficits to the tune of trillions for years and years to come. And there's really no hope unless politicians grow some, if I can say that these days, to really make some structural reforms. And it becomes politically difficult to do a lot of things. So the U.S. 10-year, and the up and coming week, we're getting supply in the long end, 10s and 30s. We're also getting some short end coupon paper. But it's the 10s and 30s. And if we go back to the extreme levels from last October, so coming out of Jackson Hole last year, Powell said pain to Main Street, and we're really serious about rising rates, and bond yields shot up almost 100 basis points in a couple months. That obviously put a lot of stress on asset prices. We're back to where we were at the extremes, but we still have this real fundamental supply in front of us that the market needs to digest, where a year ago that supply pressure wasn't there because the Fed was actually still net buying assets, which was kind of crazy when you think about it as to where we are now. So if by the end of next week, the US 10-year can't hold these extreme levels that we tested a few weeks ago in August, we've come off those levels, we tried to rally, but yet that supply pressure is coming. And so supply comes in like it did in August. Market backs up, it digested, it rallies a bit. Now we're getting back to those levels. And so again, from a behavioral standpoint, extremely important where we end up next week after the supply gets digested. And I would argue that if we're above that 430, 435 level, that a lot of pain is probably going to come to asset prices for the balance of September and into seasonal weakness we tend to see in October. When we look at equities, again, it's still very much the story of two different worlds. Large cap growth ETF, large cap, mega cap. So these are the biggest of the biggest companies, growth and value. after the lift from last October, when yields started to come down again and we started to rally in equities, you saw value lead initially, but ultimately growth led. And it was the perception of this soft landing that helped tech go. And so, the NASDAQ and tech have led. If you didn't own that this year, you're not having a great year. In fact, year over year, if you were a value investor, there hasn't been a lot of value creation when you look at what the mega cap value US ETF did, after the first rally from the lows in October up 10% to where it is now, basically up 11%. So we think the correction when it comes will be more about growth stocks and value stocks, and that's where the caution lies. Now, when we listen to earnings and companies and reports and we observe how individual companies are doing, Restoration Hardware is a high-end consumer, decorate your home kind of company. My wife buys some stuff there once in a while, and I get mad because I think she overpays for things, although the quality's really, really good. We heard from them on earnings. And so while they beat on earnings, and that's our chart shows this green E here, they didn't have good things to say about the go forward. And even at the high end of the consumer preferences, which is supposed to be still doing very, very good, it talked about difficult times to come. So, a stock like this at a minimum is going to get back to test the extreme levels from last year. We were accumulating the stock down here because we thought there was value. We actually sold it up in here because we thought relative to where analysts believed, it was just getting ridiculous. And so the stock starts to come down, analysts start to take up their numbers, and lo and behold, the stock, cracks on them. So analysts generally aren't very good at figuring out what the stock is worth, and that's a message everyone should pretty much understand. So you have to understand the behavior, and it's far more important from the perspective of making money in markets than necessarily listening to what the analysts say. So we look at the economically sensitive names like this for the high-end consumer, and then we say, well, what is the low-end consumer doing? And we look at a stock like Capital One Finance, which generally is a lower end, credit card company. And you can see that off the lows from last October, we've had nothing but failed rallies, and we can't make a higher high. And even though earnings expectations a few months ago were better than expected, the stock just can't go. And so I could show you 50 stocks like this, but in 10 minutes, I really don't have time to do that. But we're observing that more and more, that the economic fragility, which is not Apple and Microsoft and those. So if interest rates are going to go up and that duration play gets stressed, that long duration, technology asset gets stressed, then the overall markets are going to correct more significantly than we've started to see in recent weeks. And that's the big catalyst this week, and kind of what we took out of earnings and our observations here. So big bond supply coming should add some more headwinds going forward as we get into the seasonally challenged period of September, October. Have a great week, everyone.